Hey, this is Tom Nash, and the head honcho over at JP Morgan, Jamie Dimon, one of the GOATs. He just went on CNBC and left everyone speechless. After the hoopla around the Tom Lee predictions, the Dan Ives, the Gene Monster, everybody that's talking about the huge AI revolution, the 1995 moment, all the craziness that we're going to have in 2024, all the good times, all the FOMO-inducing things we heard over the past few days, Jamie Dimon came in basically saying, hey, not so fast, guys.
Confidence is up. There's more M&A chatter. Equity markets open a little bit. There's a lot of money chasing high-yield deals, so things are kind of open. Markets are high. People feel it. The way I look, remember in 1972 you felt great too, and before any crash you felt great, and then so things change. So you got to look ahead. And I do think there are things out there which are kind of concerning. We've got an eye on, and why are we doing so well? A lot of it's fiscal spending, and fiscal spending has a multiplier too. So I just think it may not come down that quick, and people may be surprised. So when people talk about, the market is kind of pricing a soft landing, that may very well happen, but, the odds at 70 or 80%, I would give them half of that. That's all.
Now, what he just said here is very simple. It's a very compelling argument, which is, look, you guys are seeing all this goodness that's coming up in 2024. I get it. But guess what? Back in 1972, back in 1998, and back in 2007, most of the market, most of Wall Street, most of analysts did not see the subprime, the dot-com bubble, or inflation coming back. Now, what he's actually saying here is two things. Number one, there's no way to know where this curveball is going to come from. That's the whole idea of a curveball. You can't see it coming. Now, we don't know yet where it's going to come. Probably not commercial real estate, but it might come. The other thing he said is also very interesting. He said, look, the market is doing well right now. The economy is doing well because there's a lot of consumer spending. Now, that consumer spending is fueled by a lot of borrowing, a lot of debt. At some point, that well is going to dry out, and then we're going to see the impact on the economy. It might take a couple of years. It's not as instantaneous as certain people expect. And he also made one more point, which is a soft landing may actually happen despite everything he just said. He admitted it. He said, look, there may be a soft landing, there may not be a soft landing, but I'm not going to sit here and say this is an 80% chance we're going to have a soft landing. He said, I'm probably in the camp of 40% soft landing. Now, that actually shows me that he definitely knows what he's talking about. Not that Jamie Dimon needed my approval, but that just shows you that he's open to all opportunities, all options. He's kind of an equal scenario kind of guy. Now, jokes aside, I think it's a very confusing time for investors right now. Given what Jamie Dimon just said, given what Tom Lee just said a couple days ago. Now, Tom Lee is a qualified guy. He got a lot of things right over the past few years. Jamie Dimon definitely knows what he's talking about, and he's privy to a lot of information about the macro, about his customers. So when you have these two GOATs coming in with complete opposite predictions about 2024, Tom Lee is bullish, Jamie Dimon is bearish, and they both make compelling arguments. Where do you as an investor take this? Because this is literally two experts telling you the opposite observation about the situation of the market. But oddly enough, there is a solution to this problem, and it's quite elegant. It's quite simple. In fact, it's quite simple in its elegance, or it's quite elegant in its simplicity. You choose. And that solution is proven to work. Last year, I thought the economy is going to go to the toilet. I thought that the stock market is going to crash. Obviously, couldn't be more wrong about that prediction. And somehow, despite getting every single prediction wrong about the market, about the macro, about anything possible, Super Bowl, NBA Finals, everything, somehow despite all of that, despite being the Stephen A. Smith of the stock market in 2023, my portfolio did over 100% from January of 2023 up until a few weeks ago. So let's get to it, and let's start with rule number one. Now, rule number one is something that Grandpa learned the hard way back in 2015 when we got banned from the Wynn Casino in Vegas over some incident. Doesn't really matter for the purpose of this video. I'm going to put it on the Patreon. Now, what Grandpa learned the hard way in 2015 and is still very much applicable in the world of investing is that whatever goes up must go down. Now, you can imagine how Grandpa learned about this, but in the world of investing, it's quite simple. If you see a stock go up absolutely parabolically, if you see a market goes up absolutely parabolically, you have to understand that motion, that movement won't last forever. Whatever goes up will go down, will correct, will go up again, go down again. And the end, what will matter is the average. What will the market do over the course of a year? It might go up, it might go down. The averages are going to dominate this game, not 1 month here and 1 week there. It's all about the long-term average. So that's why you always want to focus on the averages game, not a specific time in the market. Now, if you zoom out enough, you'll find out one simple truth. Short term means jack diddly squat. Long term is everything. So when I say long-term investing is a cheat code, it's not just a cheat code to beat the people who have more money than you, more research than you, and who day trade for a living. It's actually a no-loss strategy. As long as you stay in the market long enough, as long as you're diversified enough, there's no way to lose, as long as you don't make some of these foolish mistakes, which I'll talk about in a second. Now, rule number 2, time is the best friend of a great business and the worst friend of an empty calorie hype company. Now, there's plenty of examples. Lucid, Lordstown, Nikola, etc., etc., etc. There's also plenty of other examples. Tesla, Palantir, and many, many others. Nvidia. Now, I think Palantir is the greatest example of that, of how time cured all these complaints about the company. At the same time, when companies like Lucid, like Nikola, like Lordstown, they started out here and ended up here, Palantir went through a lot of pain, a lot of negative sentiment. But guess what? Over the course of a few years, what happened is that the fundamentals actually beat out the bad sentiment, the noise. At the end of the day, the longer time frame you're looking at a company, the more you're going to learn about their fundamentals. So if you've invested in a company that has good fundamentals, it doesn't matter what the sentiment is about the company in the short term. Great example of that right now is Google. Everybody's hating on Google. Mainstream media is telling you the stock is dead. The search engine is going to be disrupted by AI. Their AI is garbage. Gemini is bad. Bard was even worse, etc., etc., etc. And I get the concerns. But guess what? The fundamentals of Google are actually a lot better than what people are telling you in mainstream media. When there's a lot of negative sentiment, a lot of negative hype, you're going to see opportunities in the market. And those opportunities is where the sharks and the pros, they came in. They don't come in on the high spots, on when everything just already went parabolic. That's the important part. Time is your best friend if you've invested in a good company. That's why I mean you have to do the research. You have to look at fundamentals. You have to understand what you're doing. You can't just buy stocks because they're hype. If you're buying Nvidia right now, hoping to sell it in 3 months because the price will go up, that's literally the definition of the greater fool theory. And guess what? Most of the time, the fool is going to be you. It's not going to be the pros and the sharks. 80% of the money in the market is professionals. You are the 20% and you will be pushed around. Trust me, do not play that game. Now, the third part I want to talk about here is get it right and hold it very tight. Now, that's a very important lesson. There's 2 parts of any investment strategy long term. No matter what the macro does, no matter what the market does, the macro might go crazy, the market might go crazy, but guess what? If you picked it right and if you held it tight, you're always going to be all right. By the way, that shouldn't have been a rhyme. That was absolutely organic. We should put it on the t-shirt. Can't speak English. Now, the point of this is very simple. Pick the right companies, focus on fundamentals, diversify through the S&P 500. I personally own 40% of my portfolio is S&P 500. Diversify through the S&P 500. Pick the right companies and just hold it tight. No matter what happens, you're going to be all right. Now, there's a few ways to get it right. Obviously, one would be to learn some fundamentals, such as analyzing companies, modeling, and valuations like a DCF. Obviously, you can do everything for free. Go on Google, go on YouTube. There's a lot of tutorials that will teach you everything you need to know. You need to know how to evaluate companies, how to model, how to read financials, how to understand risk, how to do comparative analysis, all of that. Now, of course, you're more than welcome to join our academy on Patreon, patreon.com/Tom Nash, where we teach all of these things. We just finished the module about financial analysis. We just finished a module about portfolio management, about how to actually model your own DCFs. A lot of cool stuff. Would love to see you there. And also join our Discord at discord.gg/Tom Nash. It's free to join the Discord. Hang out with us, talk to us about stocks, etc., etc. But let's move on to the next rule. Now, the next rule is don't expect a Lambo and a yacht. Don't expect to live like the man in the penthouse and driving a red Lamborghini. That's not the point of investing. Now, you may get that. You may. But if you don't, that's not the end of the world. Your idea, your accomplishment, your ball, you always say, keep your eye on the ball. Your target should be and will be, after you watch this video, is build your retirement fund. No matter if you're 19 or 59, you're investing to build out your retirement fund. This isn't about the Lambos, the chicks, and the respect and the cloud and all of that bullshit. It doesn't matter. The great car you buy today is going to be worthless in 15 years. Guess what? No matter how good and how shiny it looks right now. That's the whole point. That's why I drive a used car. That's like a 7-year-old car. Not selling it anytime soon. But besides the point here. The idea here is very simple. Set your expectations right. Retirement fund, not Lambo. If you set that mindset right and you understand that this is a long-term game, 10, 20, 30, 40 years, whatever it is for you, it's going to be a lot easier to hold it tight than the previous rule. Now, another thing I want you to focus on is accepting the fact that you're going to screw up. I had my share of screw-ups, plenty of. Don't worry about it. It's too long for one video. Had plenty of stocks I got wrong. I got the entire macro wrong in 2023. I thought it's going to be a massive crash. I mean, I'm not embarrassed to talk about it because you're always going to have boo-boos. You're always going to have screw-ups. Nobody shoots 100% from the field. Accepting that is going to make you hard as a rock and will allow you to make better decisions. Now, there's a lot of ways to mitigate your screw-up potential, which every human has. I use specifically the S&P 500. I use the S&P 500 to diversify. If I got Palantir and Tesla wrong, which I don't think will be the case, but hey, maybe I got it wrong. Then I have still 40% of my portfolio in S&P 500, which will CYA, cover your ass. Yes, I just said it. And obviously that's my strategy. That doesn't mean you have to copy it. In fact, I insist that you don't. This is the point of these videos. It's not for you to copy what I do. It's for you to develop your own ability to think for yourself. Now, the final thing I want to say here is stay the course. Stay the course, which means buy at all times the stocks that you like, the fundamentals that are good, the index. Buy at all times and buy more into weakness. Double down on your dollar cost averaging as the stock price goes down and slow down when the stock price goes up. But buy at all times. Then you zoom out in 15 years, 20 years, all of a sudden, your cost base is at the very bottom and you never had to time the market, not even once. I think that's got to be one of the most important investing rules of all time. Now, before I let you go, get Stock MVP, stock-mvp.com. Try it out for 1 week for free. Model for yourself, DCF for yourself. Look at what insiders are doing. Look at what institutional investors are doing with your stocks. Learn for yourself. Think for yourself. Research for yourself. This is why we created Stock MVP for you. Thank you. I'll see you in the next one.